Hey team, it's the end of 2021 and we've only got a couple of trading days left this year. That means that this week will be our final opportunity to minimize our capital gains tax burden before Uncle Sam starts laying pipe in our wallets. In this video, I'll talk about how capital gains tax works and how we can use a technique called tax loss harvesting to minimize our tax burden and how to avoid wash sales. This is only for US taxes. I know the Germans particularly have some crazy tax rules. This video will not help you. And as a disclaimer, I'm not a tax professional, I'm just explaining the IRS's rules and quoting other people, so don't at me. Consult your cousin Vinny if you need proper legal tax guidance. Alright, let's get started. First, we'll talk about how capital gains tax will impact you this year. 2021 was a pretty good year for stocks. The S&P is up almost 25% this year, so unless you traded like shit, you're probably green for the year. This means you will pay taxes on your gains. For any position that you held for 365 days or less before you closed, you will pay short-term capital gains. This trading income will be taxed at your normal income level, just as though you made that money working at Wendy's. For any position you held 366 days or longer, you will pay long-term capital gains tax. The rates here are lower, and some of you probably don't have to pay any tax on your long-term gains. I'll put a link to a good resource in the description if you want to look over the tables. And the above is true for both stocks and options. So let's say you traded actively, and across 100 trades, you made a total of $10,000 on your profitable trades, and you lost a total of $6,000 on the non-profitable trades. Uncle Sam will split these into short and long-term brackets and say, you made $8,000 of short-term gains and suffered $5,000 of short-term losses. You therefore owe me a short-term capital gains tax on $3,000 of gain. Likewise, you made $2,000 on long-term positions, and you lost $1,000 on long-term positions. You therefore owe me tax on $1,000 of long-term gains. Of the $4,000 net gain, you'll probably end up paying something like $800-ish depending on your tax bracket. If you did trade like shit and lost money this year, you can write off up to $3,000 of loss from your regular income and get a tax deduction. If you had a net loss of more than $3,000 this year, you can apply additional losses to future tax years in $3,000 chunks per year until you've written it all off. A $30,000 loss will get you 10 years of $3,000 deductions, for example. Of course, when you trade, the point is to make money. But paradoxically, we also want to minimize our capital gains tax burden. We can do both of those things at the end of the year by using a technique called tax loss harvesting. Our goal with tax loss harvesting is to realize losses to minimize our tax, but do so in a way that doesn't really impact the overall portfolio positions. This is what I did over the last couple of weeks to reduce my upcoming tax burden without really having to change what's in my portfolio. That's my way of sticking it to the IRS. Let's use an example to demonstrate how to use tax loss harvesting. This year, Dimitri traded often, and after totaling up his realized gains and losses, he has a net gain of $20,000 this year. All of it is short-term gains, so according to his tax bracket, he will have to give Uncle Sam about $4,400. That sucks. So Dimitri wants to realize some losses to reduce his tax. Let's look at Dimitri's portfolio. Sitting there is a nice $8,000 loss on ARK-K, since Kathy managed to lose about 14% this year. Dimitri could pay his taxes and go into the new year with this garbage in his portfolio. Or he could sell ARK-K, realize the $8,000 loss, and reduce his taxable gains from $20,000 to $12,000. This would knock the amount of money he owes Uncle Sam down from $4,400 to $2,640. By killing off ARK-K, he gets to keep about $1,800 more of his money. I know what you're thinking, locking in that loss is throwing in the towel. He won't get that $8,000 back, so what's the point? That's the same initial thought everyone else has, so you're not alone. I'll get to that and talk about how we can minimize that aspect. For this tax loss harvesting to not be worth it, ARK-K would have to rise such that it recovers more than $1,800 for Dimitri's portfolio over the next month. And the way things are looking for ARK-K, that's very unlikely. Dimitri is almost certainly better off dumping ARK-K and getting his tax savings than he would be by holding ARK-K and praying for a significant reversal. But I said that tax loss harvesting means that we avoid significantly changing what's in our portfolio. If Dimitri dumps his ARK-K position and holds cash, then he's definitely changing his portfolio. How do we get around this? Well, assuming Dimitri still wants to hold ARK ETFs, we can use the cash to repurchase a similar position and get his portfolio back to its original condition while still claiming the tax write-off. But he can't just buy back ARK-K right away. That would trigger what's called a wash sale and disallow his tax write-off. So how do we make this work? Let's talk about wash sales and how to avoid them. So about 100 years ago, people could do tax loss harvesting by selling a stock for a loss and then immediately buying back the exact same shares. Within 2 minutes, they'd have their tax write-off, but have literally the same position. The IRS decided they didn't like that. So in 1921, they made the wash sale rule. It states that if you sell for a loss and then buy back a position in 30 days or less, then you cannot take the tax deduction. Likewise, if you try to pull a fast one by buying more shares first and then selling the old ones, then that will also result in a wash sale. As a retail trader, you cannot take a tax deduction if you trigger a wash sale. Now, that deduction isn't gone forever. If you take a $10,000 loss and then wash sale it, then you can still claim the deduction later once you finally do close the position for at least 30 days. The problem arises when you take the deduction in another tax year. This wash sale issue is why we see a lot of CNBC reports every April where a trader from Wall Street Bets gets hosed by the IRS. An active trader might make $50,000 trading and then lose $50,000. He thinks he's broken even, but it turns out that he cannot claim those $50,000 of losses because they were all wash sales. And now he owes a 5-digit sum on taxes, even though he never actually made money. This doesn't mean don't use tax loss harvesting. Just harvest correctly. Here's how we can use tax loss harvesting effectively while ensuring we avoid wash sale rules. The wash sale rule states, no deduction is allowed if the trader reopens a, quote, substantially identical position or acquires contracts to reopen a substantially identical position within 30 days before to 30 days after he takes the loss. Unless the trader is a broker-dealer, then he can still claim the loss. If you're watching this video, you're not a broker-dealer. That's pretty much all the guidance we get from the IRS. So we must avoid reopening a stock position or buying options to allow us to buy a substantially identical stock position within 30 days on either end of the losing trade. The words substantially identical are not really clear, even to tax people. Does substantially identical mean really similar, or does it mean literally the same thing? We don't know. But the following things are definitely not wash sales, so do this when tax loss harvesting. First, you can sell for a loss and buy a similar ETF or stock. For example, sell ARK-K for a loss and buy ARK-W like Dimitri. Or sell Moderna for a loss and buy iDNA, which is an ETF in the same industry with exposure to Moderna. Remember, you can buy back the original position on day 31, and it won't be a wash sale. You don't have to change positions forever. This is a technique I use to take a deduction from my shares on EWZ, FXI, and INDA. Those are the Brazil, China, and India ETFs. They all sucked this year, so I sold them to take the loss, and then I bought shares of VEU. That's an ETF that captures the whole world minus the US. So I get similar international exposure while still taking the deduction. I posted this maneuver on Patreon, and I think some of my followers copied the technique. We will all get the write-off, and it will definitely not be a wash sale. Option 2, you could trade crypto. The wash sale rule doesn't apply to crypto, at least not yet. So if you're down $4,000 on Dogecoin, you can sell it and then buy back the same position a minute later, and you'll still get the deduction. That might change in the future when the IRS figures out what a cryptocurrency is, but for now, you're good. If you're in the red on any crypto position this year, you should definitely use tax loss harvesting. You've got nothing to lose. On the other hand, here's some things that are definitely wash sales, so avoid them when loss harvesting. Number 1, like we already talked about, don't buy back the same ticker within 30 days of taking the loss. That's 100% a wash sale, and you can't take the write-off. 2, buying a high delta call option that acts like shares. So if you sell ARK-K for a loss and then buy an ARK-K call with a high delta, then that is pretty much universally considered a wash sale because you are entering a contract to buy a substantially identical position. Or number 3, using another account to buy the same stock. You can't sell Moderna for a loss on Robinhood and then buy it on Thinkorswim. That's a wash sale. You also can't have your spouse buy the same stock position. That would also be a wash sale. However, you can have your side piece buy back the position, since this rule only applies to married couples or those in domestic partnerships. After that, we get into a gray area. I can tell you now that I have done some of these, and no one has given me a hard time. In fact, some of this has been endorsed by a financial advisor. These are definitely not what the IRS had in mind when they made the wash sale rule, but by the letter of the law, you can probably do the following. If you're an expert on tax law, please do provide your input in the comments. I'm not telling you to do any of these things. I'm just saying that there are tax offices out there that say you can do this. I don't want anyone saying, well, Your Honor, I was watching Kamikaze Cash on YouTube and said, here comes the money, so now I gotta wash sale. We're not doing that. Again, consult your cousin Vinny if you need more guidance. Number 1 in the gray area. Trade one ETF for an identical ETF from another company. Popular indices like the S&P 500 have multiple ETFs that track them. According to the Kauffman Foundation, if you bought SPY at 473 and now it's 460, you can sell SPY and buy VOO. Both of those by design track the S&P 500, so it's basically the same position, but they have different fees, different managers, and are very marginally different in their holdings. You'll barely notice a difference. So don't be afraid to swap ETFs, but you still get the write-off for selling at a loss. Number 2, sell a put option. According to Fairmark.com, by the letter of the law, only contracts that allow you to buy substantially identical securities trigger a wash sale. Put options allow you to sell, and selling a put is not the same thing as buying a call. But I can tell you right now, if you sell 100 shares for a loss and then sell a very deep in the money put option that will absolutely get you assigned, then the IRS will call that a wash sale if they're checking. But neither I nor anyone else can tell you what the IRS will consider deep in the money. 1 strike in the money, 10 strikes, 90 plus delta, no one knows. So my advice, and I have done this before, is sell a few strikes in the money expiring in more than 30 days. You've got a reasonable chance of getting assigned to take your shares back, but it's not substantially identical to holding shares or buying a call. And number 3, you can trade between classes of shares. I don't really recommend this one, but I couldn't find any information whether trading between one class of a company's share to another class would be considered a wash sale. According to CPA Cheryl Rowling, the question has never really been brought up with the IRS. So if you sell Google, GOOGL, for a loss, that's Alphabet's Class A shares, and then buy Goog, GOOG, it's Alphabet's Class C, it might not be a wash sale. Same deal with Berkshire A and Berkshire B. Are those positions substantially identical? No one knows, so do this at your own risk. I can pretty much guarantee you that no one will come after you for it, but I'm just a guy on the internet. Don't listen to me. According to Wall Street Bets user Amar Sear, that's not a wash sale, but take that with a grain of salt. I strongly encourage you to not just take my word for it, but to put in some legwork and make sure you're doing what works for your tax situation. Ultimately, you should indeed do some tax management now, but do it intelligently. Remember, the simplest way to avoid wash sales is to leave your position in cash for 31 days before you buy it back. Don't be afraid of cash. That's all. Thanks for watching, and I'll see you next time.